Hello and welcome to Connect, the podcast of California MBA, where strategy, innovation, and leadership come together to shape the future of mortgage finance. This is where the voices and ideas driving our industry forward meet real world execution. My name is Paul Gigliotti, CEO of the California MBA. And if you're here, you care about building better for your business, your clients, and the future of housing. Before we jump in, I want to take a second to thank our 2026 President Council sponsors. Without them, we wouldn't be possible to have these conversations and all the advocacy and legislative work. So I'd like to thank AmeriHome, Consolidated Analytics, Loan DNA, Funding Shield, CMG Finance, Guild Mortgage, Rocket Mortgage, Western Alliance Bank, and Wiener Brodsky Kidder. Again, thank you for your continuous support and dedication, all you give our association and all you give the industry. So let's jump in. We have a really important conversation today. I'm pleased to welcome the one and only James Brody, founding manager and partner of Brody Gapp LLP. James, thank you so much for being here with us.
Thank you for having me.
I'm going to give the audience a little bit of information on you because I was so impressed with all that it is that you do in the industry and all that you bring. And we were just having a conversation. You're all over the place doing a ton of speaking engagements. You've spent years in legal trenches of mortgage banking, working with lenders, servicers, brokers, credit unions, fintech, and financial institutions on that sexy word, compliance, litigation, regulatory risk, enforcement, defense, and now a fast-moving area of AI, which is mind-boggling how quickly it's going. James brings a practical legal perspective, which is not always the case, but also on top of that, a business perspective, which is usually not the case. You understand the mortgage companies are not looking for theory. They're trying to operate, grow, and serve borrowers, manage risk, and keep up with the regulatory environment that does not seem to be getting any simpler and is always moving. I often tell people, mortgage companies specifically, we focus so much on the ever volatile rate environment, consumer sentiment, regulatory and legislative initiatives are the same way. They're changing every day and they shape the way you do your business, and you've got to focus on all of them. So thank you again, James, for being here. Are you ready to jump in, my friend?
Absolutely. I appreciate the opportunity.
Awesome. Well, let's get to it. Let's start with the current risk environment. And let's take a look at the big picture. You're working with mortgage companies across the entire country, which is insane because now that the CFPB is doing less on a federal level, a lot of state regulators are jumping in and doing a lot of oversight, but we still have our federal bill. So it's a little bit of a layering risk. How would you describe the current risk environment for mortgage lenders, servicers, brokers, and financial institutions? And what feels different right now compared to prior cycles?
I mean, listen, as far as the landscape of the liabilities and, what the industry is looking at right now, you have the fact that the federal government has taken a step back in some ways.
Yeah.
And like you had mentioned, allowed the states to sort of fill in the gap. And there is a patchwork of different laws, especially in that field of AI, where a lot of people, especially those lenders with national footprints, as well as the depositories, looking to the federal government to hopefully have some level of stability or agreement on what AI, what needs to happen with AI in this environment. And because the executive order from the Trump administration contained many shoulds, woulds, coulds, now you have state laws, whether it's Colorado, Texas, Utah, California, New York, or some of the places that are the hottest spots that are starting to fill that vacuum. And that leaves the lending community, especially the ones that have a national footprint, to build to the strongest laws, because if they build to each state, they're going to be spending a lot more money and they're not going to be efficient and they're going to have a lot of problems. But it's not just limited to the AI space. there is a lot of things going on. We were just talking in the legal issues committee for the CMBA, and a lot of people are talking about whether it is regarding, immigration status, unknowns with regards to what's happening in that sphere. So I think that's the biggest challenge for the lending community in compliance is the lack of clear direction and the different standards.
So that would be the outlier. What's different about this environment than any other? You think that it's the just the lack of clear direction?
Well, I think at this moment, that is a big issue because in the right now people are wondering, and they should know that by not complying with certain laws at this moment, they may very well in the next administration, if they do start to change, and I expect if it turns out to be a different administration, that pendulum will swing back. They have to look at the statute of limitations, what actually they are still liable for. That a lot of this is hindsight, so that it's what they do now will echo into a new administration. So I think those are all concerns. Plus, AI over the last 2 years has started to dominate every conversation, every conference, every panel. It is interjected, and I think that right now we're in kind of a great awakening where people are
Yeah.
starting to understand it.
Let's move from like let's move from talking about the current risk environment. I want to, when we first opened up, I made this statement about how the regulation landscape and compliance landscape needs to be viewed more as a function of your business. So from
Yeah.
your perspective, and I talk about that quite a bit at California MBA on stage. In fact, at the non QM conference that just occurred in Dana Point, that was the subject of conversation. So from your view, um, how important is it that compliance is looked at much more than, this back burner idea, and something that's more looked at as part of uh, how a company operates, like kind of woven into their fabric, if you will. And also, where do you think mortgage companies sometimes get this wrong with that concept?
Mhm. Listen, when it comes to the way I look at the world in the lending industry, when times are good, people tend to invest more money into compliance. When times are bad or uncertain, they put more money in litigation. The less money there is, the more they fight about it. And a lot of even in the good times, the way a lot of the lenders think about it is that, Joe Schmo down the street is doing this, that, or the other, whether it's with loan officer compensation, MSAs, whatever the issue. And they feel, well, if I don't do that, I'm not going to stay in business. So I have a choice to make. And this is where the pragmatism comes in, as the lawyer, is
Mhm.
being able to point out the black, the white, and the gray. And, in the law, there is such a thing as strategic breach of contracts. If you're going to go ahead and make out better because you breach a contract, that could be done strategically. And I think a parallel can be drawn with some of the compliance issues, not all of them, but certainly there is a gray area on some of them, whether it's through the lead buckets that had been subject to some scrutiny, or other issues of LO comp. But to your question about weaving it into the way that they operate,
Yeah.
obviously that would be the absolute best way, because if you do that from the ground up, it's going to be more efficient. You're going to have less exposure, but quite simply, that isn't the way a lot of the lenders do it.
Right. You know what's fascinating to me? I think also there's actually opportunity when you look at the regulatory landscape from a perspective of, there's constant change.
Yeah,
But if you were to kind of flip the lens on that and not look at it as burdensome, but actual opportunity, just like market conditions, right?
yeah,
Like look at all of the agency lenders that have sat back and said, okay, the consumer is now earning their money a different way. most consumers have that W-2 job, but then they also have a side hustle. I think the percentage is like 28% of individuals who
Yeah.
have applied for a mortgage, have a full-time gig, but also a side hustle, whether that side hustle is like Uber or selling like recrafted vases on Etsy or
Right.
babysitting or dog walking, like because of the cost of living,
Yeah.
interest rates increased on mortgage and credit cards, we need to make more money. And so from that opportunity of changing, so lenders looked at that as an opportunity to say, we're going to bring in some of those non-QM products, right? To jump on that bandwagon, so to speak. And what's really interesting, I just keep on trying to harp on this on the industry. Let's have Let's look at regulation and compliance the same way, because there's opportunity somewhere in there. And so I kind of took that as a takeaway from what you just said. So
Yeah.
thanks for bringing that up. We're aligned on that one.
Yeah.
I want to go into litigation and enforcement. You've been doing this for some time, and you've handled some very complex legal matters for mortgage companies, and litigation risk is always somewhere in the background for this industry. Where are you seeing the biggest litigation or enforcement risks right now, especially in that uncertainty that you were talking about?
Well, where I'm seeing the biggest risk, what we're doing the most of right now, litigation wise, is really in the poaching area, non-solicit
Right.
type cases, where, a loan officer or a branch will be recruited by a competitor. We both defend and prosecute those cases. And when you are in a time of consolidation, when you are looking at the recruitment going through the roof, competition for the top producers, that's where you want to see a lot of litigation. Now, what I see as an imminent risk is what I've done a lot of on repurchase defense. I handled about 70 of those cases that were in the Lehman bankruptcy.
Wow.
Um,
Okay.
about 10 or 11 cases with City Mortgage out in Missouri. Pretty much, because that's where I got my start, and the industry was handling the subrogation of reps and warrants claims on buybacks. And around the time of the meltdown, obviously, it was through the roof. So the Lehman cases lasted about 6 or 7 years. And when I was recently out in DC for the advocacy week,
Hmm.
and we ended up meeting with Fannie and Freddie, who are utilizing these new AI tools, the fraud discovery tools, and understanding that the fraudsters are now also, of course, using those same tools to create the fraud. Well, they are scrubbing their portfolios between 2020 and 2023, I believe, and finding, I'm certain, many ways to issue buyback demands. Now, whether or not they drop the hammer on those, when they drop the hammer on those, I don't know. But I do see that as an imminent
Oof.
risk.
Oh, something else to look forward to down the pipeline, huh? So let's stay on this repurchase.
Yeah,
How should lenders be thinking about repurchase defense today? Because it seems that's also different with,
yeah,
if agencies are now finding new ways to audit from the past, and it's
yeah.
something that a lender has already closed, what should be their game plan?
Well, and just not to push anything here, but I did put out about a 20 or 30 page article on exactly that, how to
Oh,
defend yourself
wait,
on
so where can people find this article? Can you please let
right
us know?
right on LinkedIn. It's right on
Okay.
my profile. Or they can go to our website at brodygapp.com.
Okay.
And basically, it walks you through receiving a demand letter on any given morning, and going through the process, what lenders are leaving on the table with regard to defenses, what they are paying on those that they may not need to. But the bottom line is, the best thing that they can do at this moment, in addition to setting up someone central at the company to handle a demand that comes in, making sure that the deadlines get met, making sure that the files get pulled, making sure that the due diligence gets done, is that they can take an active role in renegotiating their MLPAs, whether it's on renewal or if they don't need the investor in their portfolio, they can always renegotiate right now. The
Okay.
bottom line is that a lot of the investors will make changes depending upon the size of the institution. I mean, it's just a pragmatic reality. The more they want your business, the more concessions they'll make. And not every lender is equal in their eyes. That
Right.
being said, if you ask for 100 changes and you get back 5 changes, that could mean a world of difference, whether it's adding materiality qualifiers into your MLPA or otherwise. So I would say forward moving, that is absolutely something that they can do. And when it comes to the AI piece that we had mentioned, because those tools were not available back at some of the times that these loans were originated, there are some additional defenses that could be used if the basis for a buyback is discovered through AI that the human eye couldn't have discovered. And so I think that's also covered in the article.
That's really interesting. It's fascinating what's occurring right now, and as you're talking, I'm sitting back saying, AI, from my perspective, I keep on talking about AI and its benefits, right? And
Yeah.
of course, California MBA is an advocacy association. First and foremost, we're here to educate lawmakers on how their proposed bills really affect the industry and the consumer. So I do want to touch on AI, but it's fascinating. What I'm hearing from you is, we have to be careful with AI because the more and more we bring it out, the more and more it's being used as a negative, in the industry as well.
Yeah.
Fraudsters and things, being reviewed from, being able to play with figures, right? And then all of a sudden, of course, you have the GSEs that are coming in and saying, well, now we have to kind of go back and audit because we have these tools.
Right.
So that's going to create, a huge problem. But on the topic of AI,
Yeah.
um, and as I was talking about, one of my biggest concerns is policymakers might not understand how AI is being utilized. In fact, we were just talking to, someone on the legislative side about AI and trying to explain that, AI functionality and automated systems have been used since the late 90s, right? And it was a different technology, but the same concept of reviewing. And so you have to be really careful with the technical terminology. Um, but the goal of preventing bias is what's top of mind
Yeah.
and protecting consumers, and that is the absolute right goal. But mortgage lending being so highly regulated, well, policymakers create rules that are duplicative or conflicting or unclear. As we were talking about that layering effect with the CFPB, not
Yeah.
being as involved in state level, but so regulators are picking up and creating regulation, but we already have federal regulation. So the same concept, right? Like we keep
Sure.
on looking at this system of housing and bogging it down with regulation. I don't want to say red tape because that makes it negative, but so much regulation, it could really slow down innovation and I feel potentially hurt borrowers, right? If you
Yeah.
look at some of these bills that, want to allow borrowers to opt out of automated
Yeah.
underwriting systems, that pops a loan directly into manual underwriting,
Yeah.
which increases the interest rate just automatically, whether
Right.
it's an opt out or not. And then it downgrades that file, right? And so, how do we govern AI responsibly from your perspective without creating rules that sound good, but really don't do the work in practice? Like,
Yeah.
what should be the go to for that, do you
Gosh,
think?
the landscape of AI legislation is fairly vast when you think about the fact that there isn't the clear direction on the federal level, and the states are starting to fill in those roles. But the way I look at it, and the way I believe lending should also look at, lenders should also look at it, is that the current statutory framework all applies to these different AI tools. Fair lending, ECOA, TCPA, all of these things that they're already used to dealing with. And that is really why we're putting out that book next month to map out the tools
Love it.
to the different pieces.
Oh,
Be-
you have so many references. I love it, man.
but it's all, but seeing how much litigation there is
Yeah.
on these various pieces And, really getting to the crux of your question, I think the best thing that lenders can do, to focus on what the legislation should be is first understand what AI they have in their companies by going ahead and inventorying whether
Mm,
it is the $20 chatbot that their LOs are using to slap
right.
1003s on, whether it is, the head of HR asking ChatGPT whether and how they should fire someone they don't like. There are a number of tools that you may not think about intuitively that AI is coming through updates on your current vendors. So it's already been ingested. They just don't know where it's at. And so what they really need to be able to do is start by getting a full inventory of it. Once they understand where the AI has been ingested and they have a clearer picture of how it works in practical, reality, then I think it can add more to the debate or the dialogue on legislation and advocacy, which I think the MBA just came out with their white paper,
Hmm.
which was a continuation of the 2024 piece that they had put out on AI. And the debate of, I don't want to boil it down to pro human or pro LO versus pro agentic. But the bottom line is that there is an ongoing debate, and it's going to become more heated as the agentic AI starts to do things that are covered under that licensable activity. Who's responsible for it? Can it be done? Whether you look at the SAFE Act or otherwise. So that is going to be one of those big debates because, yes, AI is capable of doing amazing things. And I think the idea is just talking to the vendors that the safeguards that need to be put in place, I think needs to be put in place by the vendors because the lenders have a big enough job to do right now themselves without having to try and become AI experts so that they can audit those vendors themselves.
Yeah. That's very sage advice, as my grandfather would say. Very wise and sage advice. One more question before we
Yeah,
leave. You've got so much wisdom and practice under your belt. You work with companies that are dealing with the practical side of regulation, litigation, audits, compliance every day, right? So,
yeah,
for mortgage lenders who may think advocacy is separate from their business, what would you say to them about that?
they're wrong. I mean, quite simply, advocacy is critical. And whether it's the CMBA, MBA, ABA, wherever the pieces are, and I think that more of the institutional pieces need to, work together more, especially in this age of AI, because I think that the political capital of people is lessening.
Yeah,
Uh, the, the more they're able to work around a strike, people not willing to work and, just focus on their, I mean, people talk about immigration. Well, now there's 100 million digital immigrants that are going to flood the system
yeah,
that don't need to have sick time, don't have benefits, don't complain.
yeah,
And, when you have that, you don't have the same political power. And so
yeah.
right now is the time to leverage that power and really do it before some of these very obvious steps are taken that reduce the efficacy of that.
Yeah. James, so much information. Thank you for your insight, uh, for what you do for the industry, what you do at California MBA. And thank you for joining us on Connect. I personally think this conversation is a great reminder that legal and compliance issues do not sit off to the side of business. It's part of your business.
Yeah.
They affect operations, as you're saying, technology, the borrower experience. They obviously affect cost, speed, risk, but ultimately, as we were talking about AI, access to credit. So I want to thank you for being here. And again, everything you give to the industry. To our audience, thank you for tuning in to Connect. Remember to stay engaged, stay thoughtful, and keep building with purpose. And again, James, thanks for being here.
No, thank you. I really appreciate it.